All right. All right. Good evening, everyone. This is our weekly tax law training, our last one for this season. I want to take a second to thank Jared for all his time and help with this. We greatly appreciate it. Even though he makes jokes sometimes that I just have to give him an eye every now and then when he uses my name and I'm like, Jared. But just a couple quick things before we get started. We do still have the 6744s and the 4012s out in front on the porch at our United Way location on 1910 Harrington Drive. We will have them out through the weekend, but after that, they will go inside.
Hi, can you hear me?
Yep, we can hear you.
Let's see
So
what's going on. My
if you
computer.
need to get them, you'll have to go in between the hours of 9 and 5, but they will be on the porch until probably Monday when Ed gets over there. We're still looking for some individuals who might be interested in scheduling our clients. We're trying something different this year to see if we can find some volunteers to kind of help us cut down the cost of what we're paying to have our calls answered and scheduled. So if you're interested, I am going to be sending an email out again. I had sent it out earlier, but I will send it again. So if you're interested, please log in or please go through the link to the United Way's website and you can sign up there. And then I will also be sending out the site schedules. My goal is to have I'm going to be out on vacation starting January 23rd. So my goal is to have those up in VSP before then so people can be going in and getting their assignments, whatever they would like. In this email, I will also be sending out the name of the site coordinator and their email address. Everyone needs to be sending the 13615s to their site coordinator. If this is your first year, I need to get a copy of it as well so that I can set you up properly in VSP so that you can go in then and schedule shifts. We don't put anyone into unless they have passed their 136.
Hey, how you doing?
They've passed the
You were here for the VITA, right? Yeah, good to see you. Have a seat.
Hey, Hal, can you mute yourself?
Oh, I'm sorry. I'm sorry.
No problem. I know people have been going in and taking the tests. Hopefully you are not having any problems with the system. I know we had some folks who you can go into Lincoln Learn and change your email address. I know I've had some people tell me they retired or they just closed out their address, their email address, but you can change it in Lincoln Learn, but you cannot change it in TaxSlayer for the practice lab. You will have to create a new account if you have a new email address in TaxSlayer. Won't make a difference once we're actually up and doing returns in TaxSlayer because you get a totally separate login based on your site location. Anyone have any questions on any of these things before we get started? All right, if not, Jared, take it away.
All right. Thank you very much, Kim. Hopefully everyone can hear me all right here. I'm in a different office location setting here, so we'll see how the headset and everything else is working. We're going to go ahead and share our slide deck for this evening. Let me see if I can pull that up here. Working with technology. Hopefully by the end of the session, we've already got everything rolling and ready to go here. So hopefully we're able to bring up our slides. And our opportunity we're going to be talking about this evening is actually going to be a little bit different than what we've done in the past. We're going to be focusing on a couple different issues that we're going to have some unique areas. We're going to talk a little bit more about areas that involve state and local tax reporting, and then also talking a little bit more about some deceased taxpayers and military training as well. So we're going to go a little off the 4012 for this session this evening. Want to be sure that we're seeing things all right. Are we able to see the full slide deck currently? Okay, great. So just want to go ahead and talk a little bit more about kind of our state and local issues. So we are going to be preparing returns for the state of Pennsylvania if you're located in PA. The rules for Pennsylvania taxes are a little bit different than they are for federal. So one of the main differences we have is that we are not taking a look at adding items of income and deduction and a couple other things. PA has its own rules and required by the state or Commonwealth Constitution have a flat tax. So for PA purposes, when we take a look at filing requirements, we're going to take a look to see if anyone has more than $33 of gross income for PA. So gross income for PA purposes could be wages, it could be dividends, it could be interest. We'll talk a little bit more about some of the types of income in a little bit. But as long as that individual has more than $33 of gross income, they do have a filing requirement for PA. So how do we get there? Actually, the $33 times the 3.07%, which is PA's very nice and round flat tax rate, would generate $1 due, and that's our filing threshold for PA. Also, technically, you would need to file a return if you have a loss from a business, including a individual sole proprietorship, a partnership, or even an S corporation. However, for VITA, we typically do not have losses within our Schedule Cs, nor do we do K1s for partnerships and S corporation shareholders. Now, Pennsylvania does not actually exempt minors from filing requirements. So even if they're claimed as a dependent on someone's return, while federal has a fairly nice threshold that we can fall underneath, technically, Pennsylvania does not have a minimum age to file return. So we may just want to double check documents or confirm if someone wants a return filed for a minor child. Now we're going to be talking a little bit about Lancaster County, but just want to make it known here for individuals in other parts of Pennsylvania, the filing rules should be fairly identical to what Lancaster County wants to do. We're going to take a look here at our local returns. So this is only going to be based on earned income. So when we take a look at earned income, we're really taking a look at two major sources, predominantly wages and income from self-employment. So income from self-employment predominantly for VITA would include Schedule C activity. And again, it would be any active partnership income, although technically we're not handling partnership returns within the VITA program. So for Lancaster County, that would be for anyone who resided in Lancaster County for any part of the year, and also if they lived in the Octorara School District within Chester County for part of 2024 as well. Now, with local returns, so this applies not only to Lancaster County, but all counties in the Commonwealth, the tax only applies for individuals age 16 and older. So if a person is under the age of 16 and they actually happen to have taxes withheld on their W-2, what we typically suggest that they do is to file the local return, put down 0 taxable income, and just put a notation under the age of 16 until their birth date. Or if it's easier to do the math, just put the date of birth of the taxpayer and let the local municipality figure out that they're under the age of 16. So you just want to put a notation there. One other area I do want to mention, now we're at the end of the calendar year. So we are seeing a lot of local notices go out for non-filers. So one of the things we just want to remind people of, if an individual comes in with a pre-printed local form, down here in Lancaster County, it'd be the Lancaster County Tax Collection Bureau. Believe up in the Pocono area, it might be Keystone or another provider. But we can go ahead and take a look. If they are coming in with a pre-filled form, we do want to make sure that we have the return sent back to the appropriate authority. So because they're getting a pre-printed form, it means they're still in the system, which means if they don't get a return from that taxpayer, it may generate a non-filing notice, which is awfully confusing. It sounds like they're going to spend years in jail and several $100,000 of fines. What I usually suggest if they get a pre-printed form, the taxpayer may be retired. There's some other options there as well. Could be deceased, could be a student, could be a homemaker. Check the appropriate box on the pre-printed form. Have the taxpayer sign that and send that back in for processing purposes. Usually works out a little bit better there. Okay, so one of the things we're going to take a look at is for Lancaster County, again, for local returns, it's only earned income. So it's only going to be applicable predominantly if our taxpayers have earned income, generally wages or self-employment. Fortunately, TaxSlayer can generate a local return. We had a little bit of a discussion earlier about the ability to file electronically. Still within VITA, the best practice is to go ahead and file by paper because we can generate that return within the TaxSlayer system. We don't need to go ahead and rekey any information in, including the taxpayer information or their W-2 or other business activity, nor attach anything electronically. So for local returns, we can file, and that would actually have it very nice and easy to print out, and we could just send those returns in, or more importantly, have the taxpayer send those returns in. Taking a little bit of a deeper dive into PA. PA, again, is a relatively unique. All right, wonderful. Got the update here that it is actually going to be Berkheimer. Yeah, thank you very much for that clarification, Ernie. I was trying to remember which one it was. Here in the central part of the state, we have individual collectors for each what I feel like a hamlet. I'm not quite sure if I'm using the appropriate term there, but we have so many different taxing bureaus down here that each one has their own fiefdom. But outside this area, we have two main ones. Berkheimer is the large one in the upper regions of PA. So for Pennsylvania tax issues, we have a couple different classes of income. So PA is a bit unique. They don't follow the federal rules. They actually go off and restart the whole process. Now, the good news is we don't really have to understand the PA tax code that much. TaxSlayer does a very good job of actually putting the income in the appropriate category. So the 8 categories that PA has, one is going to be wage income. So again, coming off the W-2, I'll talk a little bit more about some areas we just want to be sure the W-2 would include interest income, would include dividend income, and business income. So these are all still within scope. Also includes any gains or losses from the sale of property. So those are the first 5. The next 2 are actually out of scope for VITA, and that includes our rent and royalty activity. So because TaxSlayer does not handle depreciation well, we do not have rental property within the VITA program. Likewise, we do not handle estate or trust income. That would be coming off of PA 41 or K1. So those are also outside the scope. What is in scope is actually the 8th category, which is gambling and lottery winnings. That includes winnings from Powerball and Mega Millions a couple years ago. That was exempt from PA tax, but now any gambling winnings anywhere would be taxable if you're a PA resident. So doesn't matter if you buy the winning lottery ticket at the shore, if you decide to go to Vegas or Atlantic City to gamble, Pennsylvania wants to tax all of your gambling and lottery winnings if you're a PA resident. Now, PA does give you the ability to write off some of those losses, so you can offset your losses with your gains, much like we can for federal. Although for PA, the good news is we don't have a more stringent process to go through. We don't have to itemize deductions to be able to take those. Now, one of the good parts about Pennsylvania is we actually have a lot of income that is not subject to tax. So a couple things we're going to take a look at are Social Security benefits, railroad retirement benefits, pension, and retirement distributions. Now, the last 2, we have a little asterisk there, meaning that if you took a distribution under normal retirement situation, so as long as the 1099-R is coming through with a code 7, PA is not going to tax that. Likewise, if it has a code 4, based on a inherited IRA or retirement plan, not taxable as well. So Pennsylvania, incredibly popular for our senior population. And the reason why is not due to the weather that we're having. And I can only imagine how bad it is up in the Poconos right now, but it's a little brisk out there today. Not the best for people who want to retire and enjoy outdoor living. But Pennsylvania is great because it's one of the few states in this area that do not tax Social Security or retirement benefits. So it provides a very good low tax rate to be able to live. PA also does not tax unemployment compensation, does not tax sick pay or disability payments, does not tax alimony, does not tax inheritances or any death benefits, and does not tax active military pay. And a question came up earlier in the chat, military out of scope. Actually, military is in scope now. There's actually a military certification, and I will be talking a little bit later on tonight about military tax issues. So there is a very specific certification for military, so we can actually handle that here. But PA, we're going to talk about some unique areas when it comes to military pay. Now, one other item I just wanted to mention, let me actually go back to the prior slide here. So while we have 8 different classes of income, and you have a tax-paying couple that comes in, they can file together. Now, I said together, but not jointly. Pennsylvania has a very unique system. So For those of you who enjoy mathematics and trying to make sure numbers add up, you're not going to have a great time looking at the PA 40. The reason why I say that is because Pennsylvania will not allow one person's losses to offset another person's gains. Now, predominantly the way we'd see this would most likely be under gains and losses of sale of property. So, for example, if you had a taxpayer that had $1,000 of capital gains shown from their brokerage account and their spouse had $1,000 of losses, well, in the federal return, because you're filing together, those two amounts would offset and you'd actually have a net of 0 taxable capital gain. However, for PA purposes, they do not allow a taxpayer's income to be offset by a spouse's loss. So if you take a look at the PA 40, even though you put in the exact same information, the PA 40 is going to show $1,000 of capital gains on the gain line. The reason why we cannot use the spouse's losses to offset the taxpayer's income. Also, you cannot deduct losses from one category against income from another category. So let's just say we saw that $1,000 of capital losses, but the taxpayers had $2,000 of dividend income. For federal purposes, you'd only have $1,000 of income. For PA purposes, we'll only add the positive numbers, in that case, the $2,000 of dividends, and we'll ignore the $1,000 of stock loss. There's no carry back, no carry forward. Unfortunately for PA, you just lose those amounts. But again, PA has some very nice benefit that we do not tax all income earned. In fact, it's predominantly relegated to those 8 classes we talked about: wages, interest, dividends. Could be issues of our capital gains, maybe some lottery winnings. That's predominantly where we're going to end up seeing a lot of our PA taxable income. And as I mentioned, also business income. So out of those categories, 2 of those are also going to be taxable for local. That would be our wage activity, and also our business income would also be taxable for earned income purposes. Now, I want to talk a little bit here about compensation coming off W-2. So fortunately, when we prepare a return within TaxSlayer, you're going to enter the W-2 exactly as shown. So typically what we're going to take a look at, we're going to review how to input the W-2. We just enter that information exactly as shown. State wages are going to be in box 16. State withholding will be in box 17. Now, what's unique about Pennsylvania does not tax retirement distributions as long as you're made in regular retirement. Great time for the question. It actually just popped up. How do we know that the employee has reached retirement age? Generally, that's going to be determined by the employer and would be indicated on their Form 1099-R. So if an employee receives a Code 7, that means normal retirement distribution, and they don't have to be fully retired from all occupation. They're just retired from that occupation. So we may see circumstances where someone may have reached the age of 55. They've already had 30 years of service. They retire from the company. The company is going to determine if they met their minimum retirement age, and they're going to be fine. The one issue we probably would take a look at would be the Code 1. And I'll talk about that in a little bit here, too, if we get into some of these other issues. The early distribution from a retirement account will be considered taxable income for PA. So I just want to reiterate that. We talked about that in the second session. If you see a Code 1 on a 1099-R, Pennsylvania technically will tax any of the gain, any of the earnings on that account. So what happens for Pennsylvania is they will go ahead, they will allow you to deduct your contributions first. So the way that I like to explain it, let's just assume that we had a $10,000 distribution from a retirement account. The individual had taken it early. But the way we can determine how much they actually have in contributions is to go back through their W-2s. Now, if they've only been at the company for 1 year, they only have one W-2, or maybe they were there for 2 years and they brought their prior year return, we can do that pretty quickly. The calculation is relatively significant. We probably should have the taxpayer come up with that information for us. But because Pennsylvania does not allow a deduction for retirement plans, we're going to see generally a difference in wages between box 1, federal taxable, and box 16, which is state taxable. In general, the PA wages should match box 5, which is Medicare wages. It should be following a very consistent format. But the one item I just want to kind of keep talking about here is that retirement plan distribution. So the employer is going to determine whether or not the employee met retirement age and is getting a distribution on account of retirement. If not, they may put a code 1 in, which means it's an early distribution, again, subject potentially to PA taxes. So if an individual had taken out a $10,000 distribution by leaving their company's 401k, but if we take a look back and code D in box 12 showed a total of $8,000 of contribution, the first $8,000 that comes out, not taxable. So only the remaining $2,000, the difference between the 10 taken out and the 8,000 put in, would be taxable compensation for PA purposes. This also technically would be compensation for local as well. That's the only other addition we may have to make for local taxes. So just taking a look here at the W-2 itself, just enter the W-2 as shown. Hopefully the box 16 wages will match box 5. We do take a look here at the process of how we go ahead and just enter that information. It should match box 5. Hopefully it does. But we cannot fix any W-2s. If there appears to be an issue, we can maybe have the taxpayer go back to their employer and see if there's any correction that need to be made. I also just want to make a quick caution here. Sometimes you'll see that a W-2 may have a couple different areas for a local tax. If you see something that looks like $52 or less, that's probably LST or local services tax. So not every municipality imposes one, but oftentimes we may see that there are two lines for local tax. We just want to make sure we're not doubling up on local income. So we want to make sure that the local income does not exceed the amount in state wages. And I'm just going to double check here on chat real quick. Okay. And looks like we're pretty much caught up, although just a quick question coming in from Ernie here. For those of you who know how to use Bogart, can we continue to use that approach? And Ernie, I'm anticipating this probably coming out of our just quick discussion here on retirement distributions. What we would end up doing for our purposes here, again, we take a look and see for PA, it's just a matter of recovering our basis first. So yeah, happy to address any additional questions. Feel free to throw those in chat if I haven't completely answered your question there, but want to be sure that I'm trying my best to get to the questions here. So wages, basically, we go ahead and take a look. What'll happen is that information will then be automatically applied to our PA return. No need to send copies of W-2. PA will actually generate a scheduled W-2S. So that would be going ahead and into our system. So a question that just came in, so we don't do any entries for box 18 to 20. You technically would, I do apologize here. So box 18 would be your local wages. Box 19 would be your local withholding. So you absolutely want to put those in. And then the question about box 20. Box 20 is generally a code that would indicate your local municipality. So one of the ways we can actually generate a local return is by duplicating that code from box 20 into the local tax program. So do apologize, Rob. We do want to go ahead and make sure we have box 16, 17, 18, 19, and 20 all filled out as well. So I just want to make sure that when you enter that local taxes, we're looking at box 18. It should hopefully be the same as box 16. If the number looks twice as high, we only wouldn't need to enter one of those and probably determine local withholding. Most for the flat rates we have in PA, local taxes are generally 1%. There are a couple of municipalities that have a higher amount. There are some that do not impose local taxes. I know particularly when we get up to the northern counties, there are a couple that have some different rates, including a 0. So you just want to watch if there's something on the W-2, we do want to report that. And speaking of our northern counties, there is another interesting approach here with PA, which allows for reciprocal agreements. What a reciprocal agreement means is that PA is negotiated with another state, generally a neighbor of ours, that allows for people to live in one state and work in the other without having a multi-state filing requirement. So generally what will happen is PA will allow PA residents, if they work in another state that we have a reciprocal agreement with, the employer in that state will typically withhold PA tax. If you have an out-of-state employee working in PA, typically PA employers will withhold the other state's tax. So I'll go through a quick list of our reciprocal states, and it's kind of unique. Our very first one we have is nowhere near bordering PA. So when we take a look at, and again, sorry for the geography lesson here, but Indiana does not touch PA at all. You have to go through Ohio in order to get there. But the other states do attached to PA. So we have Maryland, we have New Jersey, we have Ohio, Virginia, and West Virginia. So if an individual works in any of those states and they're a PA resident, their employer should be withholding PA tax. That allows all that to be directly reported on TaxSlayer, allows a very easy filing for PA returns. They may or may not have any local withholding, which may mean the taxpayer may have to come up with a local payment. But just want to mention that typically if you have someone in those states, hopefully they have a PA tax withheld. Here's the downside. If they work in a reciprocal state, but they withheld tax from the other state. So for example, I'll just use New Jersey because most of us are probably close enough there that if someone had worked in New Jersey and the employer withheld New Jersey tax, unfortunately, the taxpayer is going to have to file a return in New Jersey, effectively claiming zero income as a non-resident, get that refund back from New Jersey, and then file the return in PA, claiming all the income as PA taxable income. Again, because they didn't have any withholding, there's going to be probably a balance due that they'll have to pay while they're waiting for their refund for another state. Now, there are 2 states around here that are touching PA, but are not part of the reciprocal agreement. One is Delaware. The other is New York. So particularly maybe for those up a little bit closer to the New York border, if you work with New York before, they love to tax without a whole lot of give back. So there's no reciprocal agreement with New York. If you are working in New York will withhold New York taxes. If that's the case, VITA, at least for Lancaster County, does not prepare multi-state returns. It's a little bit more complex. So multi-state returns would be out of scope for VITA, at least in Lancaster County. You can do those if you would like to for friends and family. I will caution that you may want to just double check that. They are a little unique to work with. So we want to be sure we have those in good position if you are doing those for friends and family. One opportunity we do have here for Pennsylvania is we do have the ability for some deductions. So typically PA doesn't really have much in deduction. We're just looking at those 8 classes of income, but there is some opportunity here for unreimbursed employee expenses. So there's a schedule called a UE, which stands for unreimbursed employee expenses. Now, we are allowed to take a deduction for employees as long as they qualify for expenses incurred while they're at work, while they're actually working. So this has gone away from federal. We don't actually have unreimbursed expenses for normal or traditional employees for federal anymore. It's gone away, but it still exists for Pennsylvania. So I'm going to mention a couple different things here. There's some rules that we have to make sure we follow. One is ordinary, customary, and accepted in the industry or occupation you work. And I'll go through some more examples a little bit. It has to actively be used or paid while you're performing your duties of employment. It has to be reasonable in amount and not excessive. It has to be necessary for you to be properly able to complete your duties of your employment, directly related to performing your duties of employment or occupation. One of the big keys, it's not eligible to be reimbursed by an employer, whether or not you submitted for reimbursement. So one thing that PA does not want to do, PA does not want to provide a tax benefit for someone who could have received a reimbursement from their employer, but chose not to do so. So just want to kind of mention that PA does crack down on this a little bit to make sure that the individual is incurring expenses and there is no opportunity for reimbursement. So when I talk about a couple of these things, I'll make some additional commentary here. The most common ones we typically see for unreimbursed employee expenses would be things like union dues. So we have a lot of educators that might pay dues to a union. Those had in the past been reflected in box 14 of the W-2. Due to some payment issues, they may not show up there anymore. So we may just need a statement or allow the taxpayer to tell us how much they have in education dues. Or a machinist, someone who belongs to a union, can also deduct those as a condition of employment. I do want to mention, going back to the educators, we had that educator deduction for federal purposes. You can also use the educator expenses for the PAUE. The PAUE for an educator is not capped at the same levels of federal. So that's why we want to know exactly how much they paid. And as long as those materials are used in the classroom for that setting, they should be allowed for PAUE purposes. Now, the PAUE can also flow to the local return. So not only do you get it for PA purposes, but also for local as well. Do want to spend a little bit more time in this next area, which is work clothing and uniforms. So this would be equipment that you need for performing your job. It has to be required by the employer and not adaptable for general use. That is kind of our new area that we take a look at. I don't want to say it's that new, but it's something that the government will make sure that they are really unique for your business. So what do we mean by this? If you are a contractor and you're required to purchase safety equipment like steel tip boots or flame retardant pants or maybe some sort of protective gear, we see this in the medical profession, things like scrubs, non-slip shoes, things along those lines that are going to be used for your occupation should be allowable. What the government doesn't want you to do is to buy things that are adaptable for general use. Now, this was a lot easier a couple decades ago when we had a slightly different dress code for people to go out in public. I think our society has become much looser in terms of dress code. In fact, if you hop by a local retail location, you may find someone who's decided, why bother getting changed in my pajamas to go shopping? I will just put a coat on and head out the door. So general use, what we're talking about is if someone had gotten a job selling cell phones at the mall, and their employer says, we need you to dress nicely. Okay, well, dressing nicely means I'm going to put on a button-down shirt and some pants. A button-down shirt and pants is not a specific work requirement. It's adaptable to general use. You can wear that out to dinner if you like. For those people who used to get dressed up to take a train or a plane ride, that's perfectly acceptable. But those are general use elements. We cannot take general use clothing as a deduction. So that does not work. If your employer requires you to get it and it's very specific to the employer, it might be embroidered material that they make you buy the clothing, that should be fine. But again, we're looking mainly at things that are probably going to be for safety or benefit of performing your job. If you work in a construction, you have to buy some of those reflective wear gear. That's probably going to be fine because it's not really adaptable for general use. I don't see, fortunately, a lot of people wearing safety vests walking around a grocery store. So you just want to check to see what those look like. Same with small tools and supplies. Again, this is where the educator expense would come in. Anything they're buying for the classroom, you may have someone who's going out and buying some materials or tools that they need for a job. Those would be deductible as well. For example, if you have a contracting job and they tell you in order for you to work here, you need to have your own toolbox and toolkit. Well, those are required by the employer for a condition of employment. As long as they are not offering reimbursement, then you're okay. Another area we could take a look at are things like professional fees, professional license fees. So here in the Commonwealth of PA, oftentimes certain professions have to have a professional license fee. That can include things like beauticians, morticians, accountants, attorneys, all have a licensing fee. Includes nursing as well. So if you are required to be licensed, but your employer does not reimburse you, you can actually take that as an unreimbursed employee expense. Generally occurs every 2 years. So if you see one last year, you may just want to inquire. If you don't see one from the prior year, you still want to inquire anyway to see if there was anything that they had done. We're also going to talk about some vehicle expenses as long as it's not commuting costs. So this would be things like driving for the employer. As long as it's not commuting, going from your home to your place of business is commuting. That's never deductible. But if you need to drive from your place of employment, maybe to another work location, or they send you out on assignment, those could be deductible. However, only deductible to the extent that the employer does not provide any reimbursement at all. So even if the employer does not provide full federal reimbursement levels, you cannot take the difference for PA. If they provide any type of reimbursement or allow you to apply for reimbursement, these expenses would not be allowable for PAUE. So in addition to that, for the mileage, you could include things like parking, tolls, any other transportation costs, could be travel expenses while you're away from home overnight. So again, if there is nothing happening here from the employer perspective that they're not going to reimburse you, it could be eligible. Fortunately, meals and entertainment here in PA are deductible 100%. For federal, it's only 50. I'd like to say it's because PA is the snack food capital of the world. For those of you in the northern tier, we welcome you to come down here to South Central PA, where we are full of pretzel and chip manufacturers to your heart's content. A lot of chocolate manufacturers down here as well. That's not the actual reason why we get 100%, but I'd like to think it is. But PA, you get 100% of your meals and entertainment costs. Again, this has to be directly connected with a business. It's not that you're taking your neighbors out for a nice dinner and you think that you might get some business from them. It should be in connection with a business activity. So if you're not going to get reimbursed by your employer, then you have the ability to potentially take that as a Schedule UE. And as I mentioned, not only for PA, but also works for local taxes as well. A couple other little issues on our income, like that Richard Pennsylvania will probably have some T-shirts made up. Maybe we can do that for volunteers here. For interest income, there might be a slight difference between federal and PA taxable income for interest. Pennsylvania does not actually tax all interest. So U.S. savings bond interest, so bond interest from the U.S. government is not taxable for PA. Generally, it should be working okay, although I've heard that there might be some hiccups with that. You can always adjust PA interest income. When you go into tax layer, when you enter interest income, you can actually check the box that says add or edit. That allows you to make a modification for interest taxable to PA. So you can actually just enter the amount of income that's taxable for PA. PA also, in addition to not taxing federal, will not tax their own interest. So that means any interest coming from either the Commonwealth of PA or any of its subdivisions. So that includes municipal governments within PA. So if you want to have an Allentown bond in your portfolio, that interest is exempt for PA taxes. So much like our reciprocal agreement, we also have some other bonds that are going to be exempt as well. Now, these are not near PA, but I'm also presuming this is probably where our legislatures would love to vacation. Those include Puerto Rico, the Virgin Islands, and Guam. For the life of me, I have always been curious to see if anyone's ever had a bond from Guam. I'd love to see what that looks like. I've not seen that in my career. That is on my accounting bucket list to find out if I can find a Guam bond. So if you do have one, feel free to share with me if you'd like. Redact all the information. We don't need to see the taxpayers, but I'd love to see a bond from Guam. Now, in addition to the municipal bonds, federal will not tax municipal bond income. Now, there could be a situation, we don't see it very often in VITA, where you may have a client that has a series of municipal bond investments. PA will not tax bonds that are issued in PA or by municipals in PA, as well as I mentioned, Puerto Rico, Virgin Islands, or Guam. But PA would tax municipal bond interest for other states. So you may see a brokerage statement that might have a bunch of municipal bond interest. Unfortunately, they generally have a schedule which will say taxable in PA, not taxable in PA. So if you have a client that comes in and they have municipal bond interest because they bought bonds from Virginia, PA will actually tax those as interest income. Again, we'd want to modify that area there on the interest input to make sure we include the taxable amount for PA. A couple other quick issues here. One thing that PA does have as a deduction, which is incredibly popular. Now that we've talked about some income, let's talk about how do we get rid of this income. Pennsylvania has what is called tax forgiveness. So while PA is required to have a constitutional flat tax, was not supposed to have any differentiating rates for its citizens, it does actually have kind of a back end way to get around it, which is called the tax forgiveness program. So this allows certain eligible individuals to reduce all or part of their PA taxable income. The system will go ahead and generally do this fairly well, but you have to check the box to say the taxpayer is eligible for SP. And I do, before I get much further in here, want to point out the very bottom comment here. There are some people who are not eligible for tax forgiveness. If you're a dependent on someone else's return, the only way that you can take tax forgiveness is if the person claiming you as a dependent was also eligible for tax forgiveness. So I just want to put that caution out there, particularly for people who may work on returns for college students or someone else who might be claimed as a dependent on a return. You just want to double check. Don't always check the box that everyone's eligible, but it kind of becomes habit to go ahead and just confirm that they are eligible and then checking the box for tax forgiveness. As I mentioned, most of the items are going to come through appropriately to help determine eligibility for tax forgiveness. The tax forgiveness itself is based on your filing status, whether you're single or married filing jointly, and the more dependents you have, the more tax forgiveness you may have. Now, the only problem we run into is that there are times that income will impact your tax forgiveness, not your taxability, but just your tax forgiveness. The system may not know, tax lawyer may not know that you have things like alimony. So we talked about alimony in our second session about taxable income. If your divorce happened before 2019 and we're reporting alimony income for the recipient, that should be picked up by tax layer here. But if the divorce happened after December 31st, 2018, we don't put it in at all. So we may need to go back and modify the Schedule SP to add in things like alimony. The non-taxable interest should automatically come through, but things like an inheritance. So an inheritance will go ahead and increase your income for SP purposes only, not taxable for PA, but just increase your income for SP purposes. Non-taxable educational assistance, that's usually looking at scholarships. I don't think we see a whole lot of those in VITA. But one thing that does catch people every once in a while is the sale of a principal residence. So while the gain is excluded, as long as we meet the 205-year test here for home ownership and home use, at 250,000 for one individual, 500,000 for a joint couple, the amount of gain that you're excluding actually has to get added back for your income for SP purposes. So unfortunately, we may see a situation where you have a couple who's decided to downsize. Maybe they're going to move to a smaller unit. Maybe they're going to go to a retirement community. If they have tax forgiveness in the past, they may not qualify this year if they have a significant amount of income excluded from the sale of their home. That may cause a bit of a problem here. We'll also mention this again as we talk about one other issue when it comes to PA purposes, and that's going to be a fairly substantial refund opportunity. A couple other things I just want to mention here about PA, a couple other little areas are the 1099-R also has another little wrinkle to it. If an individual has a what we call non-retirement annuity, these are annuities that are purchased mainly through a commercial source, maybe a broker, maybe an insurance company. These are not inside a retirement plan. These are basically you provide money up front, and the non-retirement annuity will pay you a set sum of money over either a period of years or a lifetime. Also works with gift annuities. So anything that has a D in it, so a 7D is going to be considered as income for PA. It's going to be treated as interest income. So the provider should already have that as box 2A for the taxable amount. What'll be considered taxable, we'll just go ahead and let that flow through. Tax layer, from what I hear, is doing a very good job of having the 7D go to PA only. It will not go to local. It is not a local taxable item. It is taxable only for PA and will be reflected as interest income. And again, as we're doing the entry here, we just want to remember the tax layer will have a couple things that will allow you to do taxpayer, spouse, or joint for where the income is. That's going to be important to make sure we allocate it to the correct party for the PA return. Doesn't matter as much in the federal, but for PA, it's pretty important to get that because, again, we can't offset losses with another spouse, or we want to determine how much a spouse has in PA taxable income for a couple of really, really exciting things I'm going to mention in just 1 minute before I get to one of our oddest questions on the exam. Not the exam, I'm sorry. It's going to be on the return. Fortunately, VITA, the program does not test you on PA knowledge. It will only be for preparation of the returns. Here in Pennsylvania, we actually have a sales tax. So the sales tax is based on items that are determined to be taxable by our Department of Revenue. So here in PA, we have a couple unique items. So clothing is exempt, but luxury clothing, including leather goods, is taxable. Food typically is going to be non-taxable if you buy it at a grocery store and prepare it yourself, but food purchased at a restaurant is taxable. So sales tax is based on what you're buying and where you're buying it from. If you're buying from a PA retailer, you as a consumer will pay sales tax. You pay it to the retailer, they then pay that back over to the state. Now, one of the things we take a look at is there's a lot of different options you have to buy certain products. So here in PA, if you buy from a PA retailer, they determine whether or not there's sales tax. If for some reason you buy a product that should have had sales tax assessed, but you find out how to buy that a different way, whether you buy it online from a retailer that does not charge sales tax, or If you live close enough to Delaware, Delaware is notoriously famous for being a home of tax-free shopping. So notorious for it that that's actually on their Welcome to Delaware sign. So if you drive into Delaware, you'll see a big sign, Welcome to Delaware, the first state, because technically they signed the Constitution before PA did. Home of tax-free shopping is the next thing you're going to see on that sign. They're very proud of the fact they do not have sales tax. Consequently, you have a lot of people in the Southeast PA region that might go to Delaware. We're not going to name any names, but they may go down to Delaware to buy high-priced items, including appliances. There are big billboards along I-95 near Philadelphia to buy your engagement rings and other jewelry in Delaware to save yourself some taxes. Now, what PA knows is that they're missing out on revenue because people have now bought these items that would have been sales tax eligible by going to providers that aren't located in PA. So Pennsylvania realizes they're missing out on some revenue. So they also have, in addition to sales tax, have something called use tax. Use tax applies when you purchase an item without paying appropriate sales tax. Now, the good news for taxpayers here, for PA purposes, this is a voluntary position. PA does not have the ability to go ahead and enforce this use tax against individuals. They can only enforce it against businesses. So PA has come up with a system to say, how do we get some additional revenue? Well, you can go through on the use tax and actually add up all the items you purchased without paying taxes. I actually had a client who had done that before. She was an engineer. She came up with a detailed list of all the items she purchased, both in and outside of PA. So that way, if she bought something and she didn't feel she paid appropriate sales tax, she would include that amount on her return. You can actually come up with a number that you think that you should have paid to PA. If you ask a question of that to a client, in VITA, would you like to voluntarily report any use tax? And you're like, I have no idea what you're talking about. Zero is a perfectly acceptable answer. As long as they say, I do not, or I don't know what you're talking about, we're fine. We can do zero. You don't even need to know the exact amount. Fortunately, PA has an ability that you can actually say the taxpayer would like to make a contribution for use tax. PA is going to go ahead and estimate how much use tax they have based on their income. I just replicated a couple charts here just to show where the traditional VITA people might be. Less than $15,000, they want a $6 contribution. 15,000 to 30,000 is $12, and 30,000 to 50,000 17. If you're thinking, is this just a contribution to PA Treasury? Absolutely, that's all it is. It's a voluntary contribution to the PA Treasury. No legally enforceable action on PA use tax for individuals. It's just as if an individual would like to do that. We did double check this morning. We did not have very many people. I don't think anyone had seen this happen within the VITA program, but that doesn't mean it may not. So just want to kind of mention that use tax issue. Now, I do want to talk about a couple different items that we have. So fortunately, in addition to the PA Schedule UE and also the PASP, there are a couple other deductions and credits that may come to help reduce PA taxable income. So one of the things we're going to have here is taking a look at 529 contributions. This is a very, very beneficial rule here for PA. I'm going to mention it here. We may not see it entirely within the VITA client program, but also want to give you some more information in case you might benefit from some of these tax planning techniques. The taxpayer can actually deduct up to $18,000, and if they're married, they can do up to $36,000, so twice the 18, as long as they both have income in PA. Now, this is a contribution per beneficiary per year. Now, the great rules of these is the beneficiary does not have to live in PA. If you want to set up a 529 for a child or a grandchild that lives in Colorado, that's fine. You also do not need to use the PA program either. So you can use whatever 529 plan you like. The funds do not have to stay in the 529 plan for years. We have had some clients that need to pay 529 money or would like to use 529 to pay tuition. It can be used for room and board. Question coming in here from Richard. Can 529 be used for a flight school? As long as it would be qualified for the Department of Education, it should be. So you may just want to double check to make sure that the 529 can be used for that program. So generally, we do have the ability if it's a Department of Education authorized institution. So the benefit here is that it could be for any person, doesn't have to live in PA, for any account, does not have to be in PA. We're going to fill out a Schedule O. So that's going to delineate who the beneficiary is. We just need their social security number. And each taxpayer can take up to $18,000. It's going to be the lower of their contribution, $18,000, or the amount of PA taxable income. So 529 is a great planning technique. Another one that we could see is going to be HSA contribution. So if a taxpayer makes a after-tax contribution to an HSA, they're going to be allowed the deduction. It's going to follow the same rules we have for federal. So if you're going to fill out the 8889 for an HSA and someone's made an after-tax contribution, PA should also allow the HSA contribution as a deduction. Anything made on a pre-tax basis or by the employer, again, that's probably going to be code W on your box 12 of the W-2. That is not deductible. That's already been taken out pre-tax, but any after-tax contributions would be allowed. So you can actually make that contribution all the way through the due date of the return. Also want to mention another program, not quite as well known, but also fairly popular in terms of a deduction, would be PA ABLE payments. So a PA ABLE plan is actually a savings plan designed for individuals with disability. So the acronym, it kind of works out nicely. Not all of them kind of make sense, but this is Pennsylvania Achieving a Better Life Experience. So that's what the PA ABLE means. It provides a tax-free fund. So the money grows tax-free. You can pull the money out tax-free for disability-related expenses. Now, the benefit here is it provides an opportunity for cash and payment for things for disabled individuals, but does not impact their ability to collect government disability. Now, if you're going to put money into one of these plans, this one's still at $17,000 for 2024, but same rules as a 529, up to $17,000 per beneficiary per year. So it's going to be the lower of the amount contributed, 17,000, or the individual's taxable income. But it does have that opportunity. Again, you can use PA Schedule O to go ahead and calculate and show that benefit. One other one that worked out, this is actually fortunately an automatic position for the most part. Back in 2022, right after the pandemic, PA had actually changed their rules and allow a credit for child independent care. So starting in 2022, this was automatically coming over. This is now going to be the third year we're going to see it. If the individual had filed for a federal child independent care credit using the form 2441, that amount should automatically come over to PA. The credit's generally going to be 30% of whatever the federal amount was. So it is going to be on a brand new schedule called the PA 40 Schedule DC for dependent care. And that credit will automatically populate within TaxSlayer. For those of you here in Lancaster County, I just wanted to show a couple of the school district codes. For those of you working sites, we do have these codes available for you at the site. Just want to mention there are a couple times you may have a taxpayer come in. I've had this happen before. I asked them where do they live, and they have no idea what school district or what municipality they're in. We do need that information here to appropriately fill out the PA 40. The information I just want to mention to you, we do want to make sure the address on the federal return is going to be the current address of the taxpayer. For PA purposes for the PA 40, the school district code we want to use is the school district they lived in at December 31 of 2024. So if they move from one location, we'll use the current address on the federal form. But for the PA 40, we want to use the address they lived at December 31. If for some reason they don't know where they live, there is fortunately a lookup service by the Department of Community and Economic Development. Usually we have that website available for you. It's great because it's going to give you not only the school district, but also the municipality if you need that code for a local return. Another way to back into it is if you get a pre-printed form from a local government, it should tell you what the municipality code is. Makes it a little bit easier to go ahead and double check. I just want to take a look here at some final issues for PA, which are going to be taking a look at one of our more popular programs called the PA Property Tax Rent Rebate Credit. Now, this is a program designed for older Pennsylvanians, designed predominantly for three different groups. seniors age 65 or older, widows and widowers age 50 and older, and any individual with disabilities age 18 and older. The great news is we actually saw a change here recently, actually happened last year. They have now combined the income limitation for both renters and homeowners. So renters were actually a lot lower than homeowners in the past. They've now bumped both of these up to a $45,000 level. Once you're above that, you no longer qualify for PA property tax rent rebate. So how do we take a look at this? Fortunately, TaxSlayer will automatically calculate if you indicate that they have a PA property tax rent rebate opportunity. It's going to take 50% of their Social Security and their railroad retirement benefits. Those are going to be excluded. Depends if you like glass half full or glass half empty. 50% of Social Security gets added back. Remember, it's not taxable at all for PA, but we need to include that for purposes of the property tax rent rebate. Your other PA items of income will also be taxable. The recommendation is we do attach a couple documents, and I'll get to that in just a second. Some other items that may not be automatically coming from TaxSlayer, the same thing I talked about for the Schedule SP, inheritances, alimony, gain from the sale of a personal residence should all be included. You want to add those back in for PA property tax rent rebate. Good news is the credit is up to, or the refund here is actually $1,000. We call it a rebate because it's actually going to be reimbursing a cost. Was only $650. It went up to $1,000. We sometimes have individuals that apply for the PA property tax rent rebate, and then we get a notification a little bit later that they got an amount higher than what we put on their form. Well, one benefit PA has is that they will automatically enhance that rebate if an individual has less than $30,000 of income and they pay more than 15% of their income in property taxes. So if they are applying for a rebate, they may automatically get an enhanced version up to 50% if they're going to meet those qualifications. The state will cover that automatically. Taxpayer does not do that, but the state will adjust to refunds as appropriate. Just to give you a quick idea of where those cutoffs are. So again, both homeowners and renters are going to be in the same category. Under $8,000 is where they get their full $1,000 maximum rebate. Again, that could go a little bit higher, depending if they pay more than 15% of their income goes to property tax. Between 8,000 and 15,000 goes to 770, 15,000, 18,000 drops to 460, and then anything under 45,000 you can still get up to $380 of a rebate. Wanted to go ahead and take a look here at just a little bit more information about the PA property tax rent rebate, just what needs to be attached. So for income attachments, you do not need to attach any Social Security information at all. PA does get that information. To prove your pension annuities, you can attach a Form 1099-R, but traditionally what we have done here with the Lancaster County VITA program is attached a copy of page 1 of your federal 1040. If you do the 1040 SR for the senior version, you may have to attach both pages, or the first two, I should say, because it does actually carry over to the second page. So typically our area here for the PA property tax rent rebate has been to attach one copy of page 1 of the federal return to prove income. Now, you also need to prove how much you paid in real estate taxes or how much you have for rent. So for a homeowner, we can determine their real estate taxes if we have a receipted copy from the taxing bureau. So if you take your taxes down to get paid at the local municipality, or you stop in their office and ask if they can receipt a copy for you, they can do that for you. You can just attach a receipted copy to that submission. If they don't have a receipted copy, we can actually take a copy of the tax bill. And here in PA, typically we're going to have a spring and a fall tax. So you want a copy of the tax bill and any copies of canceled checks. So if your bank has electronic version, you may want to be sure that those get printed out. If not, make sure you can get a receipted copy. The other thing that can work, if you have a homeowner that is paying their taxes through an escrow account, the Form 1098 is going to show the amount of real estate taxes paid. That is also sufficient for documentation purposes. You can submit a Form 1098, and that will go with the application form to PA. If they are a renter, there's actually going to be a PA rent certificate form that the landlord has to complete and sign. Oftentimes, I've seen individuals come into uh, VITA and they already have that certificate filled out by the landlord. That is great. If they don't, we can help prepare that for them. We can do as much of that as possible, and they would just need to go ahead and get that form signed by the landlord and send it in with their application. Okay, so a question coming in here about inheritance reported to a taxpayer and taxing authorities. Schedule K1 from a state only shows capital gains typically. Yes, so there's a little bit of a difference between income coming off a K1, which would be if it is paid by the estate itself would pay tax on it. If it's paid out to the beneficiary includes that in their taxable income. But what we're talking about here is actually the amount of an inheritance. So rather than the income you're getting from the inheritance, we take a look at the year in which you received the actual funds. So probably what we're looking at there is what you would have paid on the PA inheritance tax return, whatever was reported in the PA 1500. So if you got $20,000 of dividends, that's what we need to add back in for the PA tax forgiveness and also the PA property tax rent rebate. So not based on income, but based on the actual inherited amount that that individual receives. Very similar, probably one-time scenario, much like the sale of a personal residence. Now, also, we want to mention one other thing here for the property tax rent rebate is taking a look at first-time filers. Once you're in the system, you're okay. We don't need to do any of this. It's only for first-time filers. So the first thing we're going to take a look at is proof of age. So this would be if you have someone who just turned 65, or maybe they moved here to PA and they're now eligible for tax forgiveness. We do need to provide a proof of age. So this is one of the most ironic elements we have in the PA tax system. The very first line you see here is a birth certificate or hospital birth records. Hopefully, most people have a birth certificate at this point. A hospital birth record is, I actually had one. I dug through my old files and I actually have one from, I was born in Lancaster, PA, so I have one for Lancaster General Hospital. Basically, it's just kind of almost like a receipt, almost like what I consider like a coat check. Hospital birth record is here are the parents, here's a kid. Congratulations, you have a baby boy. Please make sure you take him with him when you leave. Birth certificate is actually issued by the Commonwealth. Typically, the new ones are going to have that raised seal on them so they can be used for purposes like applying for a passport. The state would want a photocopy of that document. Why I say it's very ironic, because if you've ever looked at a birth certificate, the big thing they have on there is do not duplicate. I just find that ironic because the entity that issued the birth certificate for you, telling you do not photocopy it, now requests a photocopy of the document they prepared. And maybe it's just me on the irony, but they want a photocopy of their own document. Now, most cases, we probably have a different document. We can use a driver's license. Again, most people coming to VITA should bring form of ID. We can just photocopy that and send that along with the PA 1000. Passport could work. Your Pennsylvania ID card, if you don't have a driver's license, Medicaid card, PACE or PACENet card could work as well. For a widow or widower, age 50 to 64, you need that exact same information for proof of age. And you'd also need a copy of a death certificate. Now, again, the irony is the death certificate says do not photocopy, also issued within the Commonwealth of PA. But in this case, go ahead, feel free to photocopy that and send that with the PA 1000. For an individual who's considered permanently disabled, again, you'll have to be 18 or older. We do need a copy of the Social Security or SSI determination letter or the award letter. If they have a VA disability through the Veterans Administration, we need a copy of that VA letter. If they don't have either the SSI award letter or the VA letter, we can actually have a physician statement. That's called a PA 1000 PS, which is signed by a physician describing what the disability is and how they qualify for the property tax rent rebate claim. So generally, these have a little bit more popularity in sites that have an older population. If you're first time doing those, we generally should have someone who can help walk through the process, what to attach. TaxSlayer does a pretty good job of pulling this information together. There may just be a couple other things we have to add in that TaxSlayer is not aware of, like the gain on the sale of a principal residence that's excluded, alimony, inheritance, that type of thing. All right, so I'm going to hit one of the only times I'm going to mention the 4012 tonight here in talking about deceased taxpayers. So deceased taxpayers, if the couple had filed a joint return in the past, you may actually go ahead and file a joint return for the year of death of the spouse. So we generally recommend that you change the return to have the surviving spouse be the primary taxpayer. That allows that return to roll over better for the subsequent year. The first time doing a return, just go ahead and put the surviving spouse as a taxpayer and the deceased spouse as the other spouse. As long as the couple, the surviving spouse, did not remarry by the end of the year, you can still file jointly. Surviving spouse can file on behalf of the deceased spouse. There's no power of attorney needed. We can still electronically file the return with a surviving spouse. In order to generate the deceased, we just check the box taxpayer is deceased. It'll allow you to generate the date of death box. You just put that in and it'll prepare the return pretty nicely. If you have a surviving spouse and there's a refund, good news, that refund will go back to the surviving spouse. No additional information is needed. If you do not have a surviving spouse, now we have to find a personal representative to file and sign the return. Now, personal representative can traditionally be an executor, an administrator, maybe a family member who's administering the estate can actually sign for the return. Now, if there's no tax due or no refund, you're in pretty good shape. Even if you have tax due, a no surviving spouse is fairly easy. We'll just have a payment made to cover the decedent's tax bill, and we're good to go. A little bit of a wrinkle if we have a refund for a deceased party and there is no surviving spouse. If that's the case, we have to file a Form 1310. It can be populated within TaxSlayer. But we have to have some information about who the personal representative is. We'll probably be using their address on the return for any additional correspondence. If the option A or B is selected, meaning that they are a personal representative, they can document that they are really kind of a administrator or executrix or executor, then we have to file the return by paper. Only option C on the 1310 can we file electronically, but those are relatively rare. I will caution that getting a refund back with a deceased taxpayer without a surviving spouse can take quite some time. The IRS does take a long time to process those refunds. So just be aware there might be a little bit of a lag between the time that return is filed and the final refund comes back for the estate to be closed. So I just want to mention that. All right, so that actually concludes our portion for our Pennsylvania, our local, and our deceased taxpayers. So happy to take a quick break here and see if there are any questions coming in. Our next section is going to be dealing with military tax issues. So happy to have you stick around if you'd like to get military certification to take that test, or if you have questions in general about military. But you don't need to stick around if you're not planning on doing the military portion. If you have other things to get to tonight, maybe making sure that any loose items are secure around your property as these winds are whipping through, at least down here in South Central PA. Please be sure to bring any household plants in as we're probably close to another frost warning. But happy to entertain any questions anyone may have on state, local, or deceased taxpayer issues.
Hey, Jared, thank you so much for the instruction and training tonight. Kim, none of our people are going to be doing military this year, so I'm going to sign off at this point so that I can spend a little time with them. Thank you as always, Kim.
You're
Anybody have
welcome.
any questions? And then they said no. So thanks, Jared. And we're going to sign off now, okay?
I appreciate it. And good best of luck to you up there. Hope you guys
Happy
are staying.
holidays.
Yeah,
Stay
happy
cool,
holidays,
stay
Juice.
safe.
Yeah, you guys definitely probably a little chillier than we are right now, but hopefully you stay safe and warm as well. Looks like you have a great location there. So enjoy the discussion. Feel free to reach out if you have some questions for us.
Bye, Kim.
Bye.
All right. So just want to address a couple questions that just popped up in chat here as we're kind of moving through. Where is the HSA contribution entered in TaxSlayer for PA? So great question, John. That's going to be entered into the federal screen. So for HSA contribution, if we're able to take a federal deduction, that will also carry over to PA. So generally, that's going to be the form 8889. So the same place we enter into an after-tax contribution to an HSA, that will automatically flow to PA. So no special requirement there for PA. And another one that came in from Rob about inheritance only gets added in later to the PA property tax rent rebate. Earlier slide said inheritance is not taxed. That is correct. Inheritances are not taxed for income tax purposes for both federal, state, and even local. So we don't actually have the inheritance be taxable, but what the inheritance does, it impacts your taxable levels for the Schedule SP and also for qualifying for the PA rent rebate. So it's an unfortunate circumstance that may occur that someone may end up getting an inheritance that puts them over the threshold for SP or tax forgiveness. But hopefully, in exchange of getting a little bit of a rebate, they got a fairly substantial inheritance that allowed them to have more income or more cash to work with. So appreciate the questions. If anyone has one that did not go into chat yet, I'd be happy to go ahead and have you unmute and go through the process there. So just checking to see if I had missed anything as they were kind of flying through fast and furiously. Okay, I think we got most of those. I don't think, Kim, anything else is popping up there yet. So continue to have those questions come through. I'll keep keeping an eye on chat here. But now we can switch over to talk a little bit about military tax issues. So again, the high suggestion, I might beat you to this, Kim, is if you are interested in military or international certification, we highly encourage you to take the test. The more people we have eligible, the easier it is to prepare these returns because it allows us to have a deeper cadre of people who could not only do the return prep, but also the quality reviews. The more people we have, the better off we'll be.
Yeah, and if I can add on to that, Jared, if you can let Ed and I know if you are taking the military or any of the other special certifications, so that way, if we have a situation pop up, we know which site that we can send someone to because we have folks who are certified.
Fantastic. Yep. So we'll try and give you as much information as you need to get there. I will give you a couple pointers here with the military as well. Good news is when this first started, the HSA was actually buried in the military training. So for those of you who wanted to work on HSA, had to take the military. I have gone through it before and can try and give you some pointers here on the military issues as well. So this is the actual 9th year that the Lancaster VITA has been using the military certification. But again, we don't see a whole lot of these here. So if you see one, feel free to ask for help. Again, I think it helps or benefits everyone if they get to see what these return issues are. Not only do you get to see it, but also other staff members can be educated in how the return will be prepped. Anything unique, we can hold the return. There are a couple things I'm going to mention tonight yet that perhaps we want to go ahead and take a little bit more time to make sure that return's done accurately and completely. Now, because we don't live near any active military bases, or at least large military bases, we may not see a lot of military returns. Not that we anticipate to see a lot on a regular basis, but we do want to make sure that we have the ability to service people that come in here to our VITA program. Now, normally we've been using the 4012 as a reference guide. I actually suggest using the form 4491 as a compendium that has a lot more detailed examples of how to handle military income and also military deductions that we're going to talk about here. Now, there is a little bit of information in the 4012. So on D5 of the 4012 does give a little bit of an overview about what will be considered taxable and non-taxable income for military purposes. So again, the 4012 D5 is going to indicate taxable and non-military income. Generally, we're going to see this coming through the W-2 for the military personnel issued by the Department of Defense. There are often very unique codes within the Department of Defense W-2. Just be sure you enter those in the software. They may go to various places, and I'll talk about a couple other things. So the overview here, I'll talk a little bit more about wage activity. We're also going to talk a little bit about some moving expenses, some deductions that may occur there. Also, whether or not we can take some additional expenses for service members as well. So those are the three main topics I want to cover this evening, starting with our military pay. So as I mentioned, you're going to be getting a W-2 for the service individual, which should indicate the taxable amount of wages in box 1. Generally, the federal government's good about preparing the W-2. A couple different points to make here. For severance pay versus disability compensation, if you separate from service from the military due to a medical issue, the government will traditionally treat that as taxable severance pay unless you go ahead and you appeal the decision to the VA. The VA may make a determination that medical condition is actually disability and should be treated as non-taxable compensation. So if the VA comes back and determines that that disability compensation is awarded, that compensation immediately becomes non-taxable. So we may need to file an amended return if we originally reported as taxable income on a previous return, and now we have a VA letter determining that it should have been disability. Fortunately, after that disability determination letter, the government should fix it. It should not be reported as taxable income any longer. For combat pay, so if a individual is deployed, if they're serving in a combat zone, combat pay is not taxable for federal purposes. So you'll actually see that amount is low. I've actually seen people with zero because they've been stationed in a combat zone the entire term of their deployment. So again, not taxable, not going to be in box 1, but you may see code Q in box 12 of the W-2. That's going to indicate combat pay. Now, combat pay, as I mentioned, not taxable for federal purposes, but it could actually be allowable for EIC, the Earned Income Credit. So it can be treated as taxable income to increase your EIC. So you might actually have a benefit by actually, while it's typically excluded, to actually now bring that in as earned income credit to enhance the earned income credit opportunities. So something you can take a look at. For homeowners assistance and also basic housing allowance, they're not taxable either. They will not be reported as taxable income. There may be some things on the W-2 that may show taxable moving expenses, and I'll get into that in just a little bit. Now, one of the other areas I did want to mention is the impact to state and local taxes. Now, while I mentioned the federal government usually good about the W-2 showing the amount of taxable income, so what we're going to take a look at here is the federal side may be good, but there might be a little bit of a little hiccup when it comes to local taxes or state taxes. So compensation earned by a PA resident is generally going to be taxable no matter where you earn it. So if you live in PA, but you work in Colorado, it's going to be taxable in PA. If you are an active military duty pay, and while you're in PA, that is going to be taxable for PA. If you're active military duty pay and you earned it while you're stationed or training outside of PA, it's going to be exempt. Now, again, most often the W-2 will not be correct. It's also going to it generally has an incorrect amount showing for PA taxable income. So we may need to send some additional documentation to the Commonwealth of Pennsylvania, to the Department of Revenue. There's actually a way you can fax the information. If you can scan it, you can send it in by email or mail it in, whatever works best. But generally, we want to send in a W-2 and a copy of the military orders. If you don't have military orders, that's usually the best way to do it. But if you don't have the military orders, you can get a statement from your commanding officer to allocate those taxable versus non-taxable. PA actually has a very, very good brochure, the REV 612 on military pay. So it actually works out very nicely to go ahead and get some additional information on military. So again, military pay earned while you're in PA as a PA resident is fully taxable while you're on federal duty or federal active duty. But if you're training outside, so military service outside of PA is going to be exempt. So if you're in active duty or you're in armed forces, it's not taxable. So if you are in the National Guard and you're going on active duty and you're going for training out of the area, that should be exempt. So typically what we're going to do, or at least I've done it in the past, is I will get a copy of the orders from a service member. Usually they'll give me the Title 10 or Title 32 of their military basically their military reporting for duty or their statements. And we'll allocate to say how many days we're inside PA, how many days we're outside of PA, and we have to modify the presentation of PA. Again, it takes a little bit of time. So again, we may want to delay a little bit here. We may have to wait, make sure people bring their orders in, and maybe create a schedule. So these do take a little bit more time than a traditional 1040. But again, feel free to get some assistance with going through this process. So what we can do, you can actually modify that, and the REV 612 gives you information on how to modify the state return. That would also carry over to local as well. So local is going to copy what state does for taxable wages. Just want to warn you, typically the W-2s I've seen have not had local taxes withheld. So oftentimes the service member may need to go ahead and pay some additional local taxes. A couple other things I just want to mention here about the military are moving expenses. So anytime that a service member moves as a permanent change in station, they are going to be deductible. So any expenses incurred will be a deduction. Not something we typically see here. Again, we don't typically have any bases here in PA or in Lancaster County, but you may have people that might be having a retirement and moving here to the area. We do have a lot of service members who have retired here to PA. So what you're allowed to include in moving costs is your costs of moving your household goods and personal effects along with any reasonable travel and lodging. Now, what we define as reasonable is basically the shortest and most direct route available from the former home to the new home. So if we have an individual who is now leaving base in Coronado, they're at the Navy base in San Diego, and they're coming here to reside. They want the most direct, shortest route possible to move your materials. They don't want you taking a 3-week tour and deciding I'll pack everything up and take the family up to drive through Yellowstone and maybe see Mount Rushmore in South Dakota. It's got to be the most direct route. That's going to be the deductible piece. So no stopovers, no side trips, no pre-move kind of scouting trip that is not deductible. Only the mileage that you're driving from the old home to the new home would be included. Now, that would only be for expenses paid by the service member or their family. Oftentimes, they may get a reimbursement. If they get a reimbursement for those costs, we have to reduce the amount of qualified expenses by any reimbursement. The Form 3903 would be required to show any deductible moving expenses. Now, there's another way that this can happen as well. And I do want to mention oftentimes a service member would have the option of the military moving their personal effects for them. But a lot of times, a service member may say, I'll do it myself. So this is now called a personally procured move, or a PPM. I kind of like the old acronym a little bit better. It was a DITY. It was a do it yourself. But it's now called a PPM, personally procured move. This is where the service member or their family decides that they're going to actually move themselves. They let the government know. The government's going to go ahead and pay for 95% of the cost. So they're going to have that a cost that the military would have incurred. The military will give them up to 95% of that as a payment. Now, what's going to happen is the people moving are going to have to substantiate those costs. So they have to turn in all the receipts to the government. If the government has paid more than what the move costs, let's just say the government gave you $2,000 and your move was $1,500, then that $500 excess would be included on your W-2 as taxable income. So the government will already take care of that. However, if the reimbursement did not cover the cost of the move, and again, they're reasonable costs, then you can take those additional costs as a deduction on the 3903, which will then flow through the rest of the federal return. Okay. Lastly, I just want to mention some military expenses. So while we had some expenses for PA purposes only, we don't have it for federal. We do actually have one opportunity for federal deduction for military business expenses. So this is going to be areas predominantly unreimbursed uniform expenses. Where we may see these might be cleaning, dry cleaning, storage of uniform. They are deducted if they're specifically required for employment and not suitable for general use. Most cases, there's a prohibition against wearing your military dress when you're not on duty. So you don't have to put on your military attire to go ahead and attend kind of a graduation ceremony or go grocery shopping. So generally, you're only going to be in military dress for military purposes only. So any of the costs for things like cleaning your uniform, going ahead and repairing or maybe replacing some items that might be insignia rank. It could be things like any type of epaulets or swords. Those can be deducted as well if they're used for your military dress. Travel expenses for home. If you're traveling for reserve duty and that reserve is more than 100 miles away from your home, you can deduct your travel costs to get to your reserve training. In addition, if you incur costs for training like lodging and food, that can be deductible as well, as long as you were not provided the opportunity for housing and lodging on base. So if you had to provide your own lodging and food, that can be deductible as well. What's not deductible would be professional dues or social dues like Officers Club or NCO Club dues. They're not deductible. Another thing that we can see is educational expenses. So if you are in the military and you're maybe taking some additional certification, could be if you're maybe in the aviation and you're taking a kind of an instrument rating course and you're doing that outside, that can be actually deductible as long as they're required for the current trade or business. Uh, However, if you're going to qualify for a new position, so if you are a pilot in the Air Force and you decide that you would like to become involved in the government finance and accounting operation, taking an accounting course will not be deductible. That will qualify you for a different position. So again, what we're going to take a look at is the 4491 is your best source for information on military activity. So that would help you if you're taking the exam for military certification. Has a lot of great examples, real English examples, real plain language on how you can take a look at income for military and also the deductibility, like I mentioned here in these past couple slides. So wanted to thank you here. We're actually a little bit early. Unless you want me to stretch it to 8:30, I can easily do that. But have plenty of time here for additional questions, any last minute areas, whether it's a question you have or maybe a friend of yours has a question that you wanted to ask. Now is a great time to do it. But wanted to thank you for being part of the process here. Always fun for me to come back in and talk about tax law and get everyone all excited and ready to go for the exam and the start of tax season in a few short weeks from today. So hope everyone is doing well. Hope you have great success on the exam. I'll turn it back over to Kim for any final remarks, but I will be available here for some additional questions and commentary.
All right, great. Thank you so much, Jared. Again, we really appreciate all the support that you give us during this time. And we've gotten comments on your videos from all across the United States, which I think is pretty cool. So yeah, we appreciate that. Anyone else have any other questions? If not, I will close down the Zoom. Hope you all have a wonderful holiday. Any questions? All right. Let's see.